Chapter 15, Debt and Equity Capital. Long-term debt usually is substantial in amount and often extends for periods of 20 years or more. Debentures, secured bonds, notes payable, sometimes secured by mortgages or trust deeds, are the principal types of long-term debt. Debenture bonds are backed only by the general credit of the issuing corporation and not by liens on specific assets. The term bonds is used for both corporate bonds and debentures. The formal document creating bond indebtedness is called the indenture or trust indenture. When creditors supply capital on a long-term basis, they often insist upon placing certain restrictions on the borrowing company. These restrictions or covenants can, for example, prohibit the company from declaring dividends unless the amount of working capital is maintained above a specified amount. The acquisition and repayment of capital is sometimes referred to as the financing cycle. This transaction cycle includes a sequence of procedures for authorizing, executing, and recording transactions that involve bank loans, mortgages, bonds payable, and capital stock, as well as the payment of interest and dividends. The primary concern of the auditors is the proper authorization by appropriate officials in the company or by the board of directors for all debt issuances. The objectives of the audit of debt are to use the understanding of the client and its environment to consider inherent risk, including fraud risk related to debt. The auditor will obtain an understanding of internal control over debt and assess the risk of material misstatements before designing tests of controls and substantive procedures as shown on this slide and as we will discuss in the presentation. Many of the principles related to accounts payable also apply to the audit of other forms of debt. As is the case with accounts payable, the understatement of debt is considered to be a major potential audit problem. Related to disclosure of debt, the auditors should determine whether the company has met all the requirements and restrictions imposed upon it by debt agreements. Effective internal control over debt begins with the authorization to incur the debt. The bylaws of a corporation usually require that the board of directors approve borrowing. Any company large enough to issue bonds and able to find a ready market for the securities will almost always utilize the services of a large bank as an independent trustee. Many corporations also assign the task of paying interest to the trustee for either bearer or registered bonds. Highly effective control is then achieved since the company will issue a single check for the full amount of the semi-annual interest payment on the entire bond issue. For a note payable, there generally is only one recipient of interest. Companies control that disbursement in the same manner as other cash disbursements without using a trustee. After obtaining an understanding of the client and its environment, including internal controls, the auditor will assess the risk of material misstatement and design further audit procedures for debt. This audit plan does not provide for the usual distinction between test of controls and substantive procedures. This is because individual transactions will generally be examined for all large debt agreements. To document internal control, the auditor will usually prepare a written description and ask questions such as, are the amounts of new debt authorized by appropriate management? Is an independent trustee used for all bond issues? And does a company official monitor compliance with debt provisions? Audit procedures appropriate for the verification of debt include obtaining or preparing analysis of debt accounts and related interest, premium, and discount accounts. An analysis of the notes payable account will serve a number of purposes, including the verification of the payment or other disposition of notes listed as outstanding in the previous year's audit. Propriety of individual debits and credits can be established, and the amount of the year-end balance of the account is proved through the step-by-step examination of all changes in the account during the year. The accounts in the financing cycle are often relatively free of material misstatement. When misstatements occur, they may be due to improper reporting of debt, incomplete recording of debt, or improper authorization of loan-related discount and premium accounts. In some situations, note disclosure related to debt are incomplete. The auditor should examine the client's copies of notes payable and supporting documents, such as mortgages and trust deeds. Notes payable to financial institutions are confirmed as part of the confirmation of cash deposit balances. The standard confirmation that we reviewed previously includes a request that the financial institution confirm all borrowings by the depositor. Confirmation requests for notes payable to payees other than financial institutions should be drafted on the client's letterhead stationery, signed by the controller or other appropriate executive, and mailed by the auditors. Payees should be requested to confirm dates of origin, due dates, unpaid balances of notes, interest rates, dates to which interest has been paid, and collateral for the notes. The auditors may also substantiate the existence and amount of a mortgage liability outstanding by direct confirmation with the mortgagee. Bond transactions usually can be confirmed directly with the trustee. The auditor should vouch borrowing and repayment transactions to supporting documents. To accomplish this objective, the auditor should vouch the cash recorded as received from the issuance of notes, bonds, or mortgages to the validated copy of the bank deposit slip and to the bank statement. The auditor should examine payments of notes payable or mortgages payable by reference to the repayment schedule set forth in the note or mortgage copy in the client's possession. A comparison of canceled notes payable with the debit entries in the notes payable account provides further assurance that notes indicated as paid during the year have in fact been retired. In examining canceled notes, the auditor should also trace the disposition of any collateral used to secure the notes. Auditors should perform analytical procedures to test the overall reasonableness of interest-bearing debt and interest expense. One of the most effective ways to determine the overall reasonableness of interest-bearing debt is to examine the relationship between recorded interest expense and the average principal amount of debt outstanding during the year. Unless management elects the fair value option, debt is valued at its outstanding face value plus or minus any unamortized premium or discount. To test valuation, the auditors test the amounts of amortization of debt premiums or discounts. In addition, the auditors test the accuracy of the client's computations of expenses and interest payable. In the first audit of a client or upon the issuance of a new bond issue, the auditors will obtain a copy of the bond indenture for the permanent file. The indenture should be carefully studied with particular attention to debt provisions and tests for compliance. For example, the auditors will examine evidence of insurance coverage, vouch payments to the sinking fund, and compare the amounts of management compensation and dividends paid to amounts allowed by the agreements. If the company has not complied fully with the requirements, auditors should inform both the client and the client's legal counsel of the violation. The authority to issue debt generally lies with the board of directors. To determine that the bonds outstanding were properly authorized, the auditor should read the passages in the minutes of directors' meetings concerning the issuance of debt. If any of the notes payable outstanding at the balance sheet date are paid before completion of the audit engagement, such cash payments provide the auditors with additional evidence of the liability. Renewal of notes maturing shortly after the balance sheet date may alter the auditor's thinking as to the proper classification of these liabilities. As has been the case in other portions of the audit, the auditor should perform procedures to determine that any related party debt is properly disclosed. Financing arrangements and transactions can be very complex, and the details of these arrangements and transactions must be adequately disclosed in the notes to the financial statements. If the auditors determine that additional evidence is needed to verify these details, they will send a separate confirmation letter to the financial institution. For example, confirmation letters may be used to obtain information about lines of credit, contingent liabilities, compensating balance arrangements, letters of credit, or futures contracts. Because of the interest of creditors in the current liabilities section of the balance sheet and inferences that may be drawn from various uses of notes payable, adequate informative disclosure is extremely important. The essential point in balance sheet presentation of long-term liabilities is that they be adequately described, including details about the types of debt, amounts authorized and issued, interest rates, maturity dates, and any conversion or subordination features. Long-term liabilities include all debts that will not be liquidated with the use of current assets. In other words, any bonds or notes falling due in the coming operating cycle that are to be paid from special funds or refinanced will be classified as long-term obligations regardless of maturity date. Before accepting a long-term classification for maturing obligations, auditors should satisfy themselves that the client has both the intent and the ability to refinance the obligation on a long-term basis. The major restriction imposed on the company by long-term loan agreements are significant to the company's investors and creditors. Consequently, the nature of the restrictions should be clearly set forth in a note to the financial statements. Unamortized premiums should be added to the face amount of the bonds or debentures in the liability section of the balance sheet. Similarly, unamortized discounts should be deducted from the face amount of the debt. This slide shows a confirmation letter of lines of credit. These types of confirmation letters are signed by the client and specifically addressed to the client's loan officer or another official at the financial institution that is knowledgeable about the information. This expedites a response to the confirmation and enhances the quality of the evidence received. Analysis of the ledger accounts for debt and interest expense takes very little time in most audits because of the small number of entries. Consequently, most auditors prefer to wait until the end of the year before analyzing these accounts. Audit procedures intended to reveal any unrecorded liabilities cannot ordinarily be performed in advance of the balance sheet date. Such steps as the evaluation of compliance with debt provisions, test of interest expense, and the investigation of notes paid or renewed shortly after the balance sheet date must necessarily await the close of the period being audited. A copy of the loan agreement or the indenture relating to a bond issue should be placed in the auditor's permanent file. A listing of the restrictions placed on the company is extracted from these documents to facilitate the auditor's test of compliance with the debt provisions. Analysis of ledger accounts for notes and bonds payable and the related accounts for interest and discount or premium should be obtained for the current working papers file or the permanent file. In addition, the auditors should include documentation of internal control and risk assessment for debt. Owner's equity for corporate clients consists of capital stock accounts, preferred and common, and retained earnings. Balances in the capital stock accounts change when the corporation issues or repurchases stock. Transfer of ownership of shares from one shareholder to another does not affect the account balances. Retained earnings are normally increased by earnings and decreased by dividend payments. Additionally, a few journal entries, such as prior period adjustments, may directly affect retained earnings. Transactions in the owner's equity accounts are generally few in number but material in amount. The objectives for the audit of owner's equity begins, as do all of the audit plans, with an understanding of the client and its environment, including inherent and fraud risks related to owner's equity. The auditor will obtain an understanding of internal controls and assess the risk of material misstatement and design tests of controls and substantive procedures as shown and as will be discussed. There are three principal elements of strong internal control over capital stock and dividends: the proper authorization of transactions by the board of directors and corporate officers, the segregation of duties in handling these transactions and the maintenance of adequate records. All changes in capital stock accounts should receive formal advance approval by the Board of Directors. Authority for all dividend action rests with the directors. In appraising internal control over capital stock, the first question that the auditors consider is whether the corporation employs the services of an independent stock registrar and a stock transfer agent, or handles its own capital stock transactions. Internal control is far stronger when the services of an independent stock registrar and a stock transfer agent are utilized, because the bank or trust companies acting in these capacities will have the experience, the specialized facilities, and trained personnel to perform the work in an expert manner. If the corporation does not utilize the services of an independent registrar and stock transfer agent, the Board of Directors usually assigns these functions to the Secretary of the corporation. The Board of Directors should designate who is authorized to sign stock certificates, maintain records of stockholders' names, maintain custody of unissued certificates, and sign dividend checks. The duties of authorization, custody, and record keeping should be segregated to achieve control. The nature of internal control over the payment of dividends depends primarily upon whether a company performs the function of dividend payment itself or utilizes the services of an independent dividend paying agent. The use of an independent paying agent is recommended as it materially reduces the possibility of fraud or error in connection with the distribution of dividends. Although the examination of capital stock consists primarily of substantive procedures, the auditors, even in the audit of non-public companies, should acquire an understanding of the client's procedures for authorizing, executing, and recording capital stock transactions. This may be achieved by preparing a written description or flowchart of the system, or by filling in an internal control questionnaire. If the questionnaire approach is employed, typical questions to be answered include the following. Does the company utilize the services of an independent registrar and stock transfer agent? Are stockholders' ledgers and transfer journals maintained? Are entries in owner's equity accounts reviewed periodically by an appropriate officer? In a first audit, copies of the articles of incorporation and bylaws obtained for the permanent file should be read carefully. The information required by the auditors for each issue of capital stock includes the number of shares authorized and issued, the par or stated value, dividend rates, if any, call and conversion provisions, stock splits, and stock options. The auditors will also review minutes of the meetings of directors and stockholders for authorization of transactions related to the company's stock. In an initial audit engagement, capital stock accounts should be analyzed from the beginning of the corporation to provide the auditors with a complete historical picture of corporate capital. The analysis should account for the proceeds for all stock issues and be prepared in a manner that permits additions during later audit engagements. The number of shares issued and outstanding on the balance sheet date may be confirmed by direct communication with the independent registrar and stock transfer agent. When a corporation acts as its own stock transfer agent and registrar, the auditors should adopt alternative procedures to obtain evidence that is not available by direct confirmation with outside parties. These procedures include accounting for stock certificate numbers, examining canceled certificates, and reconciling the stockholder's ledger and stock certificate book with the general ledger. Many corporations grant stock options or other similar instruments to officers and employees through incentive-type compensation plans. Accounting standards now require companies to recognize compensation costs related to these awards. The accounting for these instruments at fair value presents a particular challenge for the auditors. Because options are not traded on a market, the fair values of the options are determined by using option pricing models, such as the Black-Scholes and binomial models. In this area of the audit, the auditors may decide to use the work of a specialist. The auditors should become thoroughly familiar with the terms of any stock options and stock purchase plans, and with the conversion features of debenture bonds and preferred stock, so they can determine appropriate measurement and adequate disclosure. Audit work on retained earnings and dividends include two major steps: the analysis of retained earnings and any appropriations of retained earnings, and the review of dividend procedures for both cash and stock dividends. On a first-year audit, the analysis of retained earnings and any appropriations of retained earnings should cover the entire history of these accounts. Credits to the retained earnings account ordinarily represent amounts of net income transferred from the income summary account. Debits to the retained earnings account ordinarily include entries for net losses, cash and stock dividends, and the creation or enlargement of appropriated reserves. Appropriations of retained earnings require specific authorization by the Board of Directors. In the verification of cash dividends, the auditors usually will perform the following steps: determine the dates and amounts of dividends authorized, verify the amounts paid, determine the amount of any preferred dividends in arrears, and review the treatment of unclaimed dividend checks. The presentation of capital stock in the balance sheet should include a complete description of each issue. Information to be disclosed includes the title of each issue, par or stated value, dividend rate if any, dividend preference, conversion and call provisions, number of shares authorized, issued, and in treasury, dividends in arrears if any, and shares reserved for stock options or for conversions. Treasury stock preferably is shown in the stockholders' equity section at cost as a deduction from the combined total of paid-in capital and retained earnings. In many states, an amount of retained earnings equivalent to the cost of the Treasury shares must be restricted. The transactions involving stockholders' equity accounts generally are few in number but material in amount. Because so few transactions occur, it is usually efficient to make the analysis after the close of the period. In the first audit of a new client, however, some preliminary work can be done in terms of obtaining and reviewing copies of the articles of incorporation and bylaws and analyzing the capital accounts. For a continuing client, the auditors will often find that audit time will be small in relation to the dollars in these accounts. Often when approached by the owners of a small business applying for a loan, a banker will request audited financial statements as an aid to reaching a decision on the loan application. A most significant document underlying the partnership form of organization is the partnership contract. The auditors are particularly interested in determining that the distribution of net income has been carried out in accordance with the profit-sharing provisions of the partnership contract. Maintenance of partners' capital accounts at prescribed levels and restrictions of drawings by partners to specified amounts are other points often covered in the contract. Partners' loan accounts also require reference to the partnership contract to determine the treatment intended by the partners. In general, the same principles described for the audit of corporate capital are applicable to the examination of the capital accounts and drawing accounts of a sole proprietorship or partnership. Analysis are made of all proprietorship accounts from the beginning of the business, the initial capital investment, and any additions are traced to the cash and asset records, and the net income or loss for the period and any withdrawals are verified. In the case of a sole proprietorship, a common source of difficulty is the practice of intermingling business and personal transactions, making it necessary for the auditors to segregate personal net worth from business capital. In addition to the lead schedule for owners' equity accounts, the auditors prepare an analysis of each equity account for the permanent file. A detailed analysis is essential for all aspects of a stock option plan, options authorized, issued, and outstanding. For a closely held corporation not served by a transfer agent, the auditors will often prepare for the permanent file a list of shareholders and the number of shares owned by each. And that is the end of the presentation for Chapter 14.